Today, we're diving into East Money, a true titan in China's financial technology space. It's really at a fascinating crossroads right now. So in this analysis, we're going to deconstruct its incredibly powerful business model, pinpoint what exactly drives its profits, and then take a hard look at the major structural challenges it's now facing.
So here's how we'll break it all down. We're going to start with our core thesis, the main push and pull affecting the company. Then we'll get into the nuts and bolts of its profit engine. After that, we'll examine the big headwind on the horizon. And finally, we'll look at what could balance things out and wrap up with the key risks you need to know about. All right, let's jump right in. And to really understand East Money's position today, we're actually going to start with the conclusion. The whole story here is really defined by this central conflict between a massive opportunity and a really formidable challenge.
So here's the fundamental tension with East Money. On one hand, you have this uniquely profitable business model that's just a machine for acquiring users at a low cost. It powers their very resilient securities business. But, and this is a big but, their most profitable segment, fund distribution, is facing a permanent squeeze on its margins because of new regulations. So the question really becomes, can the company's core strengths, plus this big strategic bet it's making on AI, be enough to balance out that pressure? That's the conflict at the heart of it all.
Now, to really grasp the scale of this challenge, we first need to understand just how remarkable East Money's profit engine is. We've got to break down the components and see where all that financial strength comes from.
And our analysis has to start with this number. It's pretty exceptional. In 2024, the company posted a net profit margin of 82.8%. Just let that sink in. You just don't see that kind of profitability, not in traditional finance and not even in most big tech companies. It's really the core pillar of how the market values this company.
So how do they do it? Well, it all comes down to what's called the flywheel effect. The company has these huge high-traffic content platforms that pull in a massive audience of retail investors. And here's the genius part. The cost to convert that audience into a brokerage or a fund client is practically zero. This creates this incredibly efficient and scalable funnel that goes straight from user eyeballs to revenue.
Now, if you just look at where the revenue comes from for the first half of 2025, you'd see the securities business is the big slice of the pie at 77%. But honestly, looking at it this way is a bit misleading because it doesn't tell you where the real profitability is coming from. See? This table tells the real story. The securities business is big, sure, but look at those gross margins. Both securities and the fund sales business are operating at these extraordinary levels. And it's that fund business with a margin over 93% that has historically been such a critical engine for the company's overall bottom line.
And it is precisely that high-margin fund business, that core part of its profit machine, that is now staring down a very significant challenge. And crucially, this isn't a cyclical downturn. It's a structural change.
The headwind I'm talking about is a huge regulatory overhaul known as the fund fee reform. This is a permanent, nationwide change designed to lower costs for investors. And it does that by directly taking aim at the fees that platforms like East Money earn for distributing funds.
So, the obvious and most critical question then becomes, what is the actual quantifiable impact of this reform on the company's most profitable business segment? Okay, so based on the details of the reform, the analysis points to a direct revenue hit of somewhere between 20 to 30% for the fund distribution business. And that's once everything is fully rolled out. We're talking about a significant and permanent cut to that segment's earning power. This projected hit comes from a few key things. There are direct cuts to the caps on sales service fees, lower ceilings for what they can charge on subscriptions, and this is the real kicker, a new rule that says all redemption fees have to go back into the fund itself. That completely wipes out what used to be a pretty important source of revenue for these distributors. So, while this regulatory headwind is a big deal, it doesn't exist in a vacuum, right? We need to turn now to the other forces inside the business, the factors that could act as a buffer and maybe even forge a new path for growth. The company's immediate future is really going to be defined by this balancing act. You've got the margin squeeze in the high-profit fund business on one side, but on the other, you've got the continued expansion of market share in their huge securities business, which, remember, is powered by that same super-efficient, low-cost customer acquisition model. And you can see in the data that this buffer is very real. In the first half of 2025, the company's brokerage market share actually grew year over year, from 4% up to 4.25%. This steady chipping away at the market share of traditional competitors really shows you how resilient that core business model is.
Now, looking a bit further down the road, beyond this immediate balancing act, the company is making a huge strategic bet on its own proprietary AI model called Miaoshang. And we're not talking about some minor new feature. This is a massive, high-stakes investment to try and build its next-generation competitive advantage, maybe by creating new revenue streams or by making their operations way more efficient to offset that margin pressure.
So when you've got a company with such different parts, one facing these regulatory headwinds and another one that's still gaining ground, a simple one-size-fits-all valuation just isn't going to cut it. You really need a more nuanced way to analyze it.
This is where professional analysts will often use a sum of the parts, or SOTP approach. As you can see in this framework, it lets you assign different valuation multiples to each piece of the business. So, for example, the stable securities business might get a 20 times earnings multiple, but the fund business, with all the reform pressure, gets a more conservative 15 times multiple. Now, the goal here isn't to give you a single price target, but to help you understand the process of how you'd value a complex, multifaceted company like this.
Of course, no analysis is complete without a clear-eyed look at the risks. So to give you the full objective picture, we're going to wrap up with the key risk factors that have been identified in the source material.
These risks pretty much fall into four main buckets. First, you've got regulatory risk. What if the fee reform hits even harder than projected? Second is just plain old market risk. A long downturn would hurt all their revenue streams. Third, competition isn't going anywhere from other tech giants or traditional firms. And finally, because they're a digital-first platform, they always face significant technology and security risks.
And all of this leaves us with the big, forward-looking question. Does all this intense regulatory pressure on its profit engine mean we've reached a full stop, the end of an era of incredible growth? Or could this tough period of adjustment just be the prologue to a brand new chapter, a chapter that's going to be driven by the strategic potential of artificial intelligence? The answer to that is really what's going to define this company's future.